Hello and welcome to the first in a series of podcasts we are starting from Union Bank of India. The topic of today's podcast is eagerly awaited by spectrum of our varied customers, starting from a common man, salaried class to CEOs of largest conglomerate, which is the Union Budget 24-25. To share our banking and economic research team's views on budget, we have a distinguished guest with us. It is my pleasure to introduce the Chief Economic Advisor of Union Bank of India, Ms. Kanika Pastricha. Ms. Kanika Pastricha is an economist with more than 16 years of experience. She is a MA Economics from Delhi School of Economics, Delhi University. She joined with Union Bank of India as a Chief Economic Advisor since Jan 2024. Ma'am, welcome to the podcast.
Thank you. Thank you, sir, for having me here.
Ma'am, with the same government, same finance minister, do you see any dramatic changes in the final budget next week from the interim budget in Feb 2024?
Thanks. Actually, that's the most interesting question that's catching the attention of all the investors today. See, what's happened is that the interim budget was in February 2024. After that, we've had general elections, and now the interim budget, and now the final budget. Now, in the general elections, the government has got a slimmer majority, plus the growth numbers are also showing that consumption has taken a beating, while capex led by public capex is boosting overall growth momentum. So there is a lot of attention on any consumption related stimulus in this budget. But what's even more interesting is there's a lot of fiscal space created in the interim, and that's happened from our very own RBI giving a fiscal bounty of 2.1 lakh crores. The budget for the same in the interim budget was around 89,000 crores. So net a fiscal bounty of around 1.3 lakh crores. Another 40,000 crores can come in because the budget talked about a lower tax buoyancy, a lower nominal GDP growth of only 10.5%. So maybe higher tax buoyancy can further boost revenues by 40,000 crores. Of course, banks like ours and other PSUs included have also given a dividend surprise. So net fiscal space of around 1.8 lakh crores since the interim budget already created. So the government has a lot of degree of freedom when it comes to the final budget.
What will be your expectation on fiscal deficit numbers?
So, as I said, that it's interesting that when you get such big fiscal bounties in years like these, the government always has space to spend a part of it. But in our view, when you get so much of savings, and these are, from pure non-tax revenue, it's not a revenue that's generated out of either tax hikes or expenditure cuts. This amount should be partly used for fiscal consolidation. So we think that out of that 1.8 lakh crore, fiscal bounty or the degree of freedom, the space created, at least 1/3 can get into fiscal consolidation. So 5.1 in our view should be budgeted around 4.9% of GDP. Let's see, there are varied estimates in the market. The economists are in a ballpark of in this wide range of 4.9 to 5.1%. Apart from this, we think that after deducting for the amount for fiscal consolidation, the rest of 1.2 lakh crores can be divided into maybe some more kicker for capex. That has been the focus area for this government, plus at least, so maybe 40,000 crores, 1/3 of that 1.2 lakh crores can get into capex. But more important chunk in our view, which the economy also needs, can get into boosting revenue spending or maybe an income tax cut, basically helping the common man and the general salaried class.
4.9 is a really great number. We will look for the final budget. So this gives me another question. Why is boosting consumption an important goal for India's economy at this juncture? Are there any new initiative in the final budget specifically targeting increased consumer spending, ma'am? Your views on that?
Sure, thanks. It's one of the most heated questions today being discussed by everyone who's talking about the budget, the most eagerly awaited event. See, India is basically a consumption-oriented economy. 60% of our GDP, the total output that you create on an annual basis, is being generated by consumption. Now, for instance, last year our growth was 8.2%, but large part of it was actually created out of capex.
Correct.
Public capex or some private spending, that too in government-led sectors, or household capex in real estate. However, consumption growth was only 4%.
Only 4%.
Only 4%.
Okay.
So that is one area where the government needs to focus on some stimulating measures to boost consumption, even though states have already taken the baton to do it, and they're already coming up with a lot of transfers, direct schemes to boost consumption. So in our view, what will happen is, as I stated, 1.8 lakh crores total fiscal space, 60,000 crores for fiscal consolidation. Out of the 1.2 lakh crores, the government's focus on capex does not deviate. They will do that 40,000 crores for that.
Okay.
But then 80,000 crores can be divided into consumption stimulating measures via maybe direct revenue spending pickup,
Okay.
or they can do an income tax cut. Actually, interestingly, there's an NIPFP study which shows that multipliers in both cases are similar. So the government can choose between the two.
Okay.
So maybe income tax cut or standard deduction hike from 50,000 rupees to 1 lakh rupees. Let's see if the government does anything above that, or maybe pure tax cuts. On the other hand, from the revenue spending perspective, there are a lot of measures or steps being talked about. One is PM Kisan transfer hike from 6,000 rupees currently annually to 8,000 rupees for small and medium farmers, or maybe food subsidy bill can be hiked, or any other form of transfers for schemes can be thought of. So some consumption stimulus likely, though state governments in our view are taking the baton in this case.
Standard deductions, your views, if it is reduced, it's a happy news for all salaried class. I hope so. Ma'am, are you looking for any sector specific announcements for the financial sector, especially banks?
So, when it comes to financial sector, what is a key problem that all banks are currently facing? It's the elevated CD ratio.
CD ratio, yes.
Even in the June monetary policy statement, the RBI spoke about this.
Correct.
So, issue is that every bank today says that 60% of deposits comes from households.
Okay.
And while what's happening is that in the 60% deposits coming from households, we ourselves as retail customers as well, we do not want to put money directly into deposits. We want to route that into mutual funds, equities, small savings, pension, other products, the financial savings component. Or the other part of savings is getting into real estate and gold. Though it gets routed back to banking system, but the low cost deposit or the CASA goes missing. That's facing a downward pressure, jacking up the cost of funds for banks, especially in a period where credit deposit growth wedge persists. So in this regard, we think that the budget, we'll eagerly await for any announcement in the budget to boost deposits, any tax related parity for deposits, say with all these other high yielding investment products, like short term capital gains tax is lower, while on deposits you still pay your marginal income tax rate. So maybe such kind of measures in terms of tax parity between deposits and high yielding investment products, or in case they come up with measures with regards to TDS on savings deposits. So till 10,000, or any tax relief on interest earnings on savings deposits, which is only till 10,000 rupees currently. Maybe it's hiked further. So that's the kind of measure we're looking at. In terms of other measures where RBI as a as a banking sector regulator and SEBI as an equity regulator, both are focused on curbing any kind of excesses of froth developing in the system. One such area of froth is futures and options trading.
Okay. Futures
There
and
may
options
be
trading.
there may be some tax hikes to impede the flows into this segment may come up. Though SEBI has already started to work on it. So these are the areas we would like to watch out for.
That's an interesting one. F&O segment is an interesting one. So you mean to say that deposit, they may fix some ceiling in the deposit in tax so that which will benefit the banks for that. Thanks for that, madam. Ma'am, do you expect the bond market to cheer the budget? That is one straight question.
So, of course, we expect the bond market to cheer the budget because
Okay,
if
good.
we are on the there are two sides of the spectrum today when we compare the economists' expectations on fiscal deficit.
Okay.
One is on 5.1, means maintaining the fiscal deficit given in the interim budget.
Okay.
So everything remains the same. Maybe the internals change with the fiscal space created.
Okay.
We are on the other side where we are expecting some part of the fiscal bounty
Okay.
being used for consolidation.
Okay.
So as soon as the fiscal deficit itself is lowered, in our view, there's scope for reduction in borrowings as well.
Okay.
And anyways, even if the fiscal deficit numbers,
government borrowings, central government borrowings will get reduced. Okay.
absolutely. What's happening is that even if they don't reduce the headline fiscal deficit number
Okay.
compared to the 5.1% interim budget, or the fall is not as much as what we are expecting,
Okay.
the government started with a huge cash balance of 1.7, 1.8 lakh crores.
Okay.
They may actually draw down that part of balance as well to have a cushion in terms of borrowings. So supply can reduce while demand, of course, remains buoyant
Okay.
as the absolute level of fiscal deficit falls in the economy.
Okay.
So bond markets likely to cheer, maybe some more downward pressure on yields. So we stay positive on duration.
Okay, positive on the bond market, so hope that bond market cheer. Madam, what is your view on sector-specific announcement, particularly infrastructure, defense, sunrise sectors? What is your view on that, ma'am? We want to know.
See, actually, on a broader framework, what is the government focused on? There are, the first focus the government has been maintaining has been capex.
Okay.
See, come to think of it, way back pre-COVID period, FY15 to 20, capex as percentage of GDP used to be around 1.7% of GDP.
Okay.
It's already been doubled to 3.5%.
3.5%. Yes, exactly.
So which means even if the government is raising fiscal deficit, a large part of the deficit has been used to increase capex spending.
Okay.
And capex is an area which promises high growth, low inflation economic framework in the medium term.
Good.
So from that standpoint, we think that the focus on capex will remain.
Okay.
Now we all remember the interim budget FM number on capex of 1.11,
Yes.
11.11 lakh crores.
lakh crores.
And that may be upped a bit,
Okay.
maybe by 30-40,000 crores more.
More.
But in our view, in this 11.11 lakh crores number,
Okay.
the FM had an unallocated capex number of 70,000 crores.
Okay.
That was sitting with Department of Economic Affairs.
Okay.
First, that may be allocated to a lot of schemes on the ground.
Okay.
Maybe Jal Jeevan Mission,
Jal Jeevan Mission.
maybe
Okay.
Awas Yojana. So
Okay.
basically urban infrastructure planning that we need. But another round of hike in loans for capex, interest-free loans for capex to states, that may be undertaken.
Okay.
Because in the RE for last year, they had actually reduced it a bit.
Okay.
But currently for FY25 budget, it's at 1.3 lakh crores. Maybe they up it a bit and then allocate it to states.
So loan to state government for capex, there may be some hike. That is
Absolutely.
our view on this. If I
Absolutely, because they can implement some of the capex plans even better. Even though there's a lot of discussion these days that the central government is reaching its absorptive capacity, they'll not be able to spend on capex beyond a point. And see, in the manifesto, the sectors which actually gained a lot of focus was railways, defense. They may attract a larger share in capex again this time.
Yeah, that is a great, madam. Ma'am, do you think the budget will be laid down the roadmap for long-term economic views of the government?
See, if you remember what happened in the interim budget as well, the government kept talking about Viksit Bharat 2047.
Yes.
When they want India to transition from a lower middle income economy currently to become a developed economy by then. And in the interim, upper middle income economy by the end of this decade, before the end of this decade itself. So yes, the focus on manufacturing as the next key growth driver, from services, which is again our core growth driver currently. So like consumption services is another 60% of GDP. So the government is focused on boosting manufacturing, which is why this focus on logistics, ease of doing business, infrastructure, most importantly cost of capital. See, come to think of it, today when the central government continues to reduce borrowings and is on a fiscal consolidation path, it actually reduces interest rates. Cost of capital
Cost
for
of
borrowers
capital.
comes down.
Okay.
And MSME is another important sector. We didn't cover that in detail in capex,
Okay.
which is going to be, which actually contributes to 40% of exports, another 30% of overall, manufacturing sector output. So that's another segment where we think focus will come in
Okay.
to ensure that they also participate in the overall growth story.
Okay.
So yes, Viksit Bharat 2047
Okay.
with a focus on lowering cost of capital, providing congenial environment via logistics, ease of doing business, infrastructure, capex as a growth driver to ensure high growth, low inflation model. That is likely to continue.
Okay.
So in the interim, the economy needs boost, consumption boost for all-round broad-based private capex recovery. The government is expected to create some conditions around that as well.
Okay, that is good news. It's very good thoughts, madam. Thank you for your sharing your valuable time to share thoughts on Indian budget. Even it is some of the audience may be hearing new jargons, new words. I hope they will understand everything. Thank you very much for your time, madam.
Sure.
If anything you want to convey regarding the budget, it's up to you. 30 seconds I give to you. You can just start.
Sure. So what I'll just say is that first of all, thanks for the opportunity. Really grateful. And as you said, this is the first in a series of podcasts we are doing from Union Bank of India
Yes.
to help our clients and the broader audience understand about the budget.
Yes.
We think that it's going to be an important event,
Okay.
but budget is not the be all end all. Today the government is taking a lot of reform decisions, policy decisions outside the budget as well.
Okay.
But yes, for some sectors, the key core sectors, infrastructure or manufacturing, be it EVs, railways, defense, this is going to be one key announcement post the general elections to watch out for.
Okay.
So yes, lot of excitement around it,
Okay.
and even post the budget, we'll keep our clients and audience updated.
Thank you, ma'am. Thank you, friends and audience. Shortly, we'll come up with another podcast post budget. Thank you to everyone.